Welcome to the Commercial Property Podcast. My name is Suzi Carter. I am a chartered surveyor. I've been involved in commercial property in the UK for 30 years and I've done hundreds of commercial property deals. I'm here to be your guide through the commercial property market, whether you're an experienced investor or whether you're literally thinking about dipping your toe in the world of commercial real estate. I will be here talking to you about all kinds of things commercial real estate in the UK, and I've also got some fantastic guest experts who are joining me. So please do subscribe if you'd like to follow, and if you'd like any more help or information on commercial real estate, please do click www.suzicarter.com, which is my website, and you can find out all the ways I can help you. So stay tuned for this week's episode. Welcome back to the Commercial Property Podcast. And today we're talking about something that I hear a lot from new clients, especially when I have residential investors who I start working with and they're relatively new to commercial. And it's interesting how when I first start working with this particular group of clients, a lot of what we're looking at initially, a lot of the deals they bring to the table are all development deals. Because of course, what you do with residential or most residential investments is you want to make the property look better and potentially even make it bigger. So when you buy maybe a dilapidated property, you're looking at doing an extension, a loft conversion, making the bathroom and the kitchen look better, decorating, probably putting some nice furniture in there because we're trying to improve the bricks and mortar valuations. Obviously with commercial, the approach is totally different. It doesn't really matter how it looks. I mean, obviously we don't want it to look a total mess for some types of property. Others, it doesn't actually matter as much. But what we're looking at is what rent we can achieve and what multiplier or yield we're going to apply to that rent. And really all of that is about risk. So we basically, the name of the game with commercial is we want to make the property less risky. And I'll talk about that, how we do that in a minute. And we also want to improve the rent because our valuation is rent divided by yield or rent divided by the multiplier. And therefore, every time the rent goes up, the capital value goes up. So we're really interested in getting that rent as high as possible. But equally, we're also interested in reducing the risk because that's going to make our yield lower. And when we have a lower yield or yield compression from when we buy the property, we might buy at a higher yield and do something to the property which makes it more attractive, less risky, and then that the valuation will reduce the yield off the back end of our asset management. Then what we're looking at then is something called yield compression. We're making that yield lower and we're forcing that value through to make sure that happens. And obviously that can happen with market movement as well. You know, if you buy at a 10% yield and the market improves and you might get a reval at a 9% yield, but in this current market, you can't rely on that. Eventually, the market is going to improve and increase, and certain types of property will increase before others, where there's more demand and less supply. But ultimately, we want to force value through at the moment. That's the name of the game. So very different with residential versus commercial. And that's where I see, new residential clients who've to date invested in resi development deals, because you have to do development or at least some refurbishment with residential. They're looking for commercial deals that have development angles. Now, you can do development in commercial, but the point is you don't have to. You can do new build development, you can do extensions, you can, do infill sites, you can get planning on yards or car parks, all really great strategies. But that's not the point. The point is that you don't have to develop. And, I think there's a bit of disbelief sometimes when I'm working with residential investors because they're like, wow, this is actually a lot less hassle, a lot less hands-on than actually it would be if it was a residential counterpart type property. So those deals where, there's uppers to convert or where you can actually build a block on or whatever, you don't have to do those. And in fact, if there are development angles on a commercial site, I would recommend you do the kind of the low hanging fruit, the asset management first, and then you can always get on with the development later. as a general rule, you would usually do your asset management first, whether that's increasing rents or in enhancing leases or increasing lease lengths, whatever that might be. And then you can do the development later. Obviously, there's always exceptions to every rule, but there's a general rule that's what it's about. So when you're approaching your commercial investing, the first thing that I work with, but certainly my board clients on, because I work with my board clients a lot more kind of on a one-to-one basis, is, starting with the end in mind. Where do you want to get to? And what do you need? Are you looking for cash flow? Are you looking for profit? Or are you looking for equity? And it's like a triangle. So cash flow is at the bottom, profits in the middle, and equities at the top. So what's the relevance of this? Well, the fact is that cash flow is basically your monthly expenses. Profit is like the equivalent of your work bonus, and equity is like your pension. Now, if you go straight into profit deals, straight into development deals, where you're kind of feast or famine, getting a lump sum from development, putting large sums into a development, and then having to wait to get that money out, then that is very stressful if you haven't got your cash flow covered, your monthly outgoings. Once you've got your monthly outgoings covered, then obviously crack on, do as many profit deals as you possibly can, if that's what you want to do. But getting that cash flow covered is really important. And I see a lot of people kind of coming in and skipping the gears. So, looking at these development deals when actually they haven't got their cash flow requirements covered yet. And, life can be really stressful sitting in profit when that's not the case, because, it is feast or famine. You've either got loads of money in the bank or, you haven't got any. That's the nature of kind of development if you don't kind of manage your cash flow properly. So doing these cash flow deals is really important to get that basic level sorted, and then you can move on to either commercial or residential deals in that profit sector. And I was talking to a client this morning, and we were talking about, she wanted cash flow, but she also wanted longer term growth. Well, the fact is you can have both. You can have your cake and eat it in the commercial world, because this is all down to the type of property that you buy. You can buy any old type of commercial property, but if you put some thought into it to begin with, then what you will be looking for is the type of product, and this is kind of the tick list, really. This is the kind of the wish list. You'll be looking for a property that yields you cash flow that you need. Obviously, you might have other criteria on deals like money out or whatever, but that's down to the individual. And then if you buy the right type of commercial property in the right location where supply and demand is in your favor, because ultimately that's all commercial property is supply and demand, then actually you could, you need to keep reviewing it, but you could hold that commercial property for many years. And many commercial investors have done this, 20, 30, 40 years ago, maybe even more. They've owned property in generations in family trusts. And that's because if you buy the right type of real estate, it's not going to go down. It's going to, it might have its blips, but it's going to, as long as the fundamentals are right, you're buying in the right location, supply and demand's in your favor, then, it's going to keep yielding capital growth for as long as you want it to, really. And what we're finding about a lot of the retiring landlords that are in the market at the moment is they've owned these properties for many years, and they have, it's put their children through university, schools, bought them houses, and all being relatively hands off as well. So that's the beauty of it, is that you can actually have your cake and eat it. But there's a big but with regard to that. You need to buy the right property in the right location. Obviously, there's a skill to that. And I've talked about that on these podcasts. I've talked about niching. I've talked about assessing supply and demand. And I'm sure I'm going to talk about it in the future as well on these podcasts as well, because that's really fundamental. So make sure you get that cash flow covered first off. And that means that if you do want to go into profit deals, into development deals, you can do that. But you don't have to in commercial, and that's the point. What's really important with commercial, and what's going to turn the dial on those two factors, the rent and the yield, is the tenant, the lease, and the property. So that's what we're looking at: the tenant, the rent, and the lease, and the property. So what the tenant, who the tenant is, what the rent is, what lease terms they're occupying on, and the type of property that you're occupying. So first of all, let's look at tenant and rent. So tenant is really, really important because you can sign a 50-year lease with somebody, but if they're not going to be around in 3 years' time, then it's not worth the paper it's written on. So when we let to tenants, we want to make sure we do checks and balances to make sure that they're going to be around in, for as long as the lease lasts and beyond. That's called our tenant covenant. And we check that by looking at their accounts, Googling them, doing credit checks on them, speaking to them. And if we can't get comfortable, then, thinking either A, do we want to actually do the letting at all? Or B, what checks and balances can we put in place to protect ourselves? That's things like guarantors, guarantees, rent deposits, etc. So that's the first thing, but the tenant is so important, and valuations will differ depending on the tenant. So if you've got a blue chip tenant on a 10-year lease versus a startup, then the blue chip will always get a better yield because it's less risky. Remember, what we're dealing with in commercial real estate is risk. So we want to reduce that risk as much as we possibly can. And then we look at the rent. Now, obviously, like I said earlier, the higher the rent is, the higher the capital value. So what we want to do is set the rent as high as possible, but not make it unaffordable for the tenant. That's the other thing about the tenant covenant, is that if the rent's unaffordable, then as sure as eggs, that tenant might go under at some point. So what we want to do is we want to make it affordable, but we want to make it as high as possible. But we also want to have mechanisms in our lease which mean that rent can be renewed. So that's rent reviews, whether that's kind of open market rent reviews or whether that's CPI, RPI kind of index linked rent reviews as well. And ultimately as well, we want to be tracking the market to see where the rent is in that market well before we get to those kind of lease events of lease renewals and rent reviews. So the rent is really important because every time the rent goes up, the capital value goes up. So we don't need to rely on one tenant. We could multi-let a property. That's much less risky, actually, because you've got lots of different tenants paying the rent. And so if one goes under, the rest will keep on paying. We can put other income on properties like EV charging, advertising, hoardings. We can build additional units, obviously getting into the profit space. We can multi-let because we're going to get higher rents for smaller space, or we can combine units because the demand in the market is for combined units, not individual units. So this is where your kind of niching comes in, this market knowledge you've got as to how to invest properly. And that's really, really important. We need to know what's working in your particular market that you're investing in. So we've got tenant, we've got rent, we've got lease. So the lease basically is the contract by which a tenant pays their rent and occupies the property. And obviously, if a lease is negotiated properly, it's going to protect both parties' interests, actually. So as the landlord is going to make sure that the tenant repairs according to their obligations, they pay their rent on time. There's remedies in place in case they don't pay their rent in time. They'll pay there's insurance provisions. They'll pay the insurance. So a full repairing and insuring lease is obviously pretty much the best type of lease you can get. But the lease terms are really important. And the better the lease is, the easier that property is to manage. And also the better your valuation will be. I've seen a lot of things I've looked at myself to invest in, and also clients have brought to me where landlords have just been so hands off that they haven't bothered renewing leases. They've got tenants holding over on licenses, all of which is pretty risky from a landlord's point of view. And what a valuer does when they look at those kind of properties is they'll say, well, that tenant could literally leave overnight, because if there's no kind of proper lease in place, a tenant can just leave very often. And so that's really risky. Basically, what they'll assume is that property is vacant, and they'll value it from a kind of vacant possession perspective. Now, we don't want that with our investments. We want to make sure that the valuer looks at our investments and says, yes, that is a good lease. Our tenant's is tied in for a long time or a decent period of time. And, if you buy a property, there can be good opportunities in the market where you find opportunities where leases haven't been renewed, or tenants are holding over, under licenses or short-term leases, because if you can actually improve those leases then you're going to see some yield compression. You'll probably see some rental increase as well because they haven't been touched for a while, but you're definitely likely to see some yield compression, i.e. you're going to be able to get that valued at a better yield because it's going to be less risky once you put everybody onto proper lease terms and, tenants are tied into leases. So leases are really, really important from all sides. You need to make sure that the lease is done properly, so that every party within that relationship know what they need to be doing. And if they don't do it, there's remedies in that lease which basically allow the landlord to take possession or the tenant to kind of have some comeback on the landlord. So from an investment point of view, really, really important. And overriding all of that is the property. So obviously, tenants won't locate in on properties or in locations where they're not going to do good business. Hopefully that goes without saying, but it's really worth saying it. So location is so important. But, a tenant won't just trade from any old property. They have an optimum size and configuration that they want to trade from, whether that's an industrial, office, retail, pub, leisure, whatever else. There is an optimum size and shape that they want to operate from. So location is absolutely important. There's a reason why that saying location, location, location came about. That came from the commercial world because tenants are so location sensitive, because, it means a difference between them trading well and not trading well. So they might want to be near their target customer. They might want to be near footfall. They might want to be near the workforce. They might want to be near arterial roads or motorways. They might want to be in a location where there's easy access, lots of different reasons why that might be. They might want to be in locations where there's access to the grid because they can put, solar panels there or, data centers or whatever else. So location is really important, but then the micro choices they make in terms of configuration, size, number of stories, specification comes into play. So this might sound really confusing, but ultimately this is why we niche, because there are so many different types of businesses in the UK, and therefore there's so many different types of commercial property. So what we're really interested in with commercial is making sure that we really understand our niche or niches so that we become the expert in that market. We know where the tenant demand is, we know what the supply of properties in that market are, and we know where the sweet spot is between the two. And ultimately, that is the key to great investing in commercial property. What we want to do is find properties where we can get longer leases, good tenants, and have some rental inflation over time.
This episode is brought to you by Bond Finance Limited, your trusted partner for commercial property mortgage solutions. Are you an experienced residential property investor about to diversify into commercial property, looking for funding options? Bond Finance can help. Whether you're planning to expand, refinance, or make a major property investment, Bond Finance provides expert advice with access to a wide range of lenders, from high street to specialist. Book a free discovery session today to explore how we can tailor commercial funding solutions to your unique investment strategy. Visit www.bondfinanceltd.co.uk and take the next step in your commercial finance journey.
And, we can't rely on the market at the moment. The market is a funny beast, not helped by, political situation externally. And so we need to force value through ourselves. And this is why you don't need to develop necessarily. The only reason you develop is to create a right size space for the tenant demands. So, if a unit's too big and there's nobody looking at it, would actually more tenants look at it if it was smaller? So could you subdivide that into one or more units? Would your rent increase as a result? So the only reason that we have to develop when we're doing asset management is whether we want to, right size the space or create space that the market really wants. And therefore we're going to get a better valuation. We're going to get better rent for it. So that's the name of the game. And this is, I think, where if you're new to commercial, whether you've come to the residential world, that power of paper-based asset management strategies may not be totally apparent from the outset. So, we can do paper-based, lease-based, rent-based asset management that doesn't, sometimes just letting a vacant unit can be as good asset management as anything else. So, I've got clients who have taken over, bought properties, and there's been a vacant unit and they've spent £3,000 on a lick of white paint, but they've just changed agent, and that's how they've got the property let quicker. So we need to make sure that we understand the market, and we need to make sure that we understand how to add value. And very often, not always, very often, this is paper-based asset management. So this is why when the penny drops with new clients and they say, I don't need to develop, do I? Not only is there a big sigh of relief very often, because you don't need to kind of gear up those building teams with all the risk and time and cost overruns that you might be seeing. But what you do need is a team around you, so that you understand how to add the value on a paper-based way, improving the tenant, improving the rent, improving the lease. But ultimately, all that comes down to is buying the right property in the right location so that you can achieve all of the above. So you definitely you don't have to develop in commercial. You might want to develop with commercial. And very often paper-based asset management is what you're looking to do. Just a little shout out for my board. So I recruit to my board. It's a small group mentoring program. It lasts 6 months. It opens in March and September, so that the intakes are in March and September. I'll put the link below this podcast, but if you are interested in the board, we do have rolling intakes on the board, and all this kind of stuff is what I teach on the board. I hold clients' hands with looking at properties and working out all the different multiple exits and helping them actually achieve their goals through their asset management. So if you're interested in the board, I'll just put a quick shout out to that and a link below. So I will see you next time on the Commercial Property Podcast.